Well, good evening to you, everybody. Welcome one, welcome all to Market Monday. We're back at it as always, 6 p.m. Central Time, right here, Facebook, YouTube. Blair Nightingale kicking off the Go Tradeway TV channel for the week of November 13th. So, welcome to you guys. Some of you guys will be watching this on recording later down the road, but for those of you joining me live tonight, welcome. We've got some good stuff to cover for you tonight. The last couple of weeks, we've been doing the market update that we do every Monday night here on Market Monday. So we're going to look at the U.S. stock market, look at the indexes, get an idea what's happening in the price, because that's what we care about as traders. But we're also going to look a little bit at the news. I mentioned many times in the last month or so, news matters to the long-term investor to get a sense of the season and the outlook, right? We don't know the future because of the news, but it helps us get a projection. For the trader, news has a different role. News is to help us gauge volatility. Can it be so negative that it'll give us a sense of direction? Yeah, potentially, but that tends to be in the moment, right? We've got some news coming up this week. We'll have to wait to know what it actually is. So that doesn't help us today. How does it help us today? Knowing that it's coming. As a trader, knowing that it's coming so that we can prepare for volatility. Now, we always want to build trades with a plan in mind to begin with, but knowing what news is coming should be part of that plan. So we're going to cover that here tonight, as well as that over the last few weeks. I've also been trying to just go back to some of the foundation and look at some interesting market dynamics in terms of learning patterns, buy points, trading instruments. There are different things than just stocks, right? Not just stocks. We're going to look at that a little closer tonight too, as we look a little bit deeper at ETFs. For those of us who know what an ETF is, I'll show you maybe some interesting pieces that you've not seen yet or seen in a while. And for those of us who are brand new to the idea, ETFs is something I want to go through, as it's something that is ever more popular on Wall Street. And it seems like there is an ETF for just about anything out there. If you want to trade a specific industry, sector, idea, if you want to go against the market, if you want to leverage against the market, with the market, you name it, I will show you in just a minute. But before we get into that, we've got Mr. Cannon James is jumping in on the chat here from YouTube. So if you're with us on Facebook or YouTube, of course, as always, you can jump into that chat box there. Let us know you're here. Let us know what you're doing out there in the markets. Any questions you might have, anything you want to submit to me here that I can go over on the show, even if it's not specifically connected to something I'm looking at, although it certainly can be. I would love to dive into that with you, answer that for you. We've got a mix tonight, guys. Tradeway students, okay, people who are in our program, been working the system, learning with us. And then, of course, those you may have just come along here on Facebook, YouTube, and you're just interested to know, hey, how do we use the stock market, right? Can we? I was just in Colorado Springs this past weekend with 600 brand new students, and a lot of them had the same experience I had in 2015, have the same experience a lot of Tradeway students have, is I didn't know that stock trading is what it actually is. I didn't know you could go in and use the software and find patterns and build trades off of patterns on the screen. We looked at this in last week's episode. That's a skill that you don't need a Wall Street degree for, right? You don't need an Ivy League degree. You don't need an investment bank internship. You don't need a business background. You don't need a wealthy uncle, right? All of those things can serve their purpose and have their place. But the idea that you and me have to have those things, or Wall Street will never make any sense to us whatsoever, is simply not true. And we'll have many people on joining us tonight who are discovering that very thing. So appreciate everybody being here tonight. I'm excited. That is who we are here at Tradeway. Tina coming in on YouTube from California, right? Finished our step 2 options class. So looking at directional options, puts and calls, okay? Puts make money when the market goes down, when the stock goes down. Calls make money when the stock goes up. So you're able to use the market both ways. For some of you guys out there, that might be the first time you've ever actually heard that. You know, I spoke to many students this past weekend, as I do on the weekends when I meet folks. They've always been trained to think one thing. The market going up means your 401k, your IRA, whatever your investments are, or maybe just overall general economic outlook, that must be positive. It's going up, that's got to be positive. Okay, it's going down, that's got to be negative, right? And for the trader, that is not the case. Okay. For the trader, it actually doesn't even really matter. Okay. It doesn't mean we're insensitive to recessions and economic hardship, but we know that those things happen as a result of economic cycle, and much of it is beyond what we can directly control. So we actually learn to protect and promote our money regardless of what the market is doing. It means we're using education to move into empowerment and stepping out of what otherwise would be just victimization, being dependent on an industry that says we can't possibly self-manage or understand investing and trading for ourselves. So we have to have Wall Street to do it for us, right? So excited to have everybody here. Now, a couple of things. Diving into this week here, okay? You can see, we had a little bit of a mixed day today, but going to a bigger view here, we're going to the S&P 500. Just starting, Friday, you can see, in fact, if I zoom in a little bit here, from when we were together last week, here, of course, is Monday, Friday, Thursday, Wednesday. Wednesday, we moved right up into support. And then the next day, as we would expect, in line with the pattern, it hits resistance and begins to drop, okay? Really strong move up. So in any time you get a really big move like that, a pullback we can expect. I'm going to change my 10-day moving average to a 5-day moving average. Remember, the moving average is just literally that. It's an average that is plotted on the screen by the software that's just saying, what's the average price of this stock over the last 5 days in the case of the 5-day moving average. And then, it plots it on the screen, right? In this case, in a red line, okay? So it fell down into the 5-day moving average, which then becomes a psychological point for the buyers to step in. They did. They pushed it higher on Friday. Good, strong grind upwards all day Friday. Nice move off of the 5-day moving average. And then today, a little bit flat, most likely in anticipation of, after a big move on Friday, do we really want to keep this thing going? Do we really want to push this higher? Maybe not yet. Why? Because Tuesday morning, we're going to get an inflation reading. We're going to get several big inflation readings this week. Okay. It's going to be Tuesday morning, Wednesday morning. The CPI is coming out. Now, the CPI is our inflation reading. You've heard me talk about this a lot over the last year. That matters because it directly affects a lot of parts of the U.S. economy. But the main one for Wall Street to look at is the data going to be positive or negative tomorrow? And the interpretation there is that the Federal Reserve is going to have to process that information and make a decision on interest rates. I had a student today. Let's zoom out of this. Okay. Made a very good point. We've broken out of resistance. We're out of the downtrend here. We may not hold here. It's possible we fall back down into that trend, but we are currently holding outside of that pattern. Okay. So the strength has certainly been there to break the downtrend that started back here in midsummer of this year. Okay. Very consistent. We saw a lot of great patterns. I've talked about this, right? NVIDIA had a really nice move off of the support level. CrowdStrike continues to move higher. Apple had a really great breakout of the downtrend, and so on, right? We saw lots of great patterns in that move, but we didn't drop off resistance. We burst right through that. So what the pause means is let's wait and see, because if it looks like the Fed will not raise the interest rates again, okay, then they're going to be very happy about that. They would rather that be over, okay? I don't believe Wall Street overall. Honestly, this is just my sense. They don't really, there's a rosy outlook about the economy, and if they can just continue to buy on the idea that in 6 to 8, 12 months, we're going to have cheaper money in the economy because the Fed is going to pull back from the fastest rate hiking cycle that they've ever done, then they're going to get excited about that, at least in the short term, right? So I had a student ask today, Blair, this kind of looks like a bit of a W pattern, which is definitely a bullish pattern. Okay. It can be very explosive, but it's a little bit strange to see a pattern like that because, well, it looks like a lot of things are negative, right? Now, it's interesting. I won't go too far into this tonight. A lot of the data is positive, right? And yet the experience for a lot of Americans and others depends on the kind of data you're looking at. When you're looking at household savings, when you're looking at household credit card debt, when you're looking at delinquencies, when you're looking at costs in the grocery store, okay, it's getting more and more difficult for Americans. When you look at the statistics on how many people are living paycheck to paycheck, how many people are only now able to pay interest on debts and not even into the principal, who are upside down, that is increasing. At the same time, these big companies are printing profits on Wall Street. And so they're willing to jump in and buy the stock when there's even a flicker of hope that the Federal Reserve may pause the rate cycle or even lower it down at some point next year. So we don't always see in the chart on the S&P or in our stock what we think maybe we should see because of negativity elsewhere. One of the most important things as traders that we are going to have to learn and accept is that the chart is going to do what the chart is going to do. And we use the chart to make decisions more than anything. Remember that I said news primarily is going to help us understand volatility. Tomorrow, we're going to expect a little bit more movement. Now, it doesn't mean we always get high volatility, but we're prepared when those big items come. CPI is a big item. A Fed meeting is a big item. Things like that. An earnings report is a big item on an individual stock, right? So that's something we've got to pay attention to. We are sitting right above this 200-day moving average, okay? So we're holding in a bullish position. Little pullback today, but it held by the close of the day. So if we can get even semi-good news tomorrow, I would see no reason why we can't make another push higher here outside of this downtrend. But of course, Wall Street waiting on that particular news. Today, perfect example, you guys. Wall Street, they get the American debt by one of the major ratings agencies got downgraded. So like for you and me, we have our credit score, if you will. Well, American debt gets a credit score, okay? And it was downgraded. Now, in the past, whenever we've been downgraded, at least in the short term, that's been a pretty significant event. It's created volatility and sell-off, uncertainty on the markets as this sense of American economic stability and consistency is deteriorating, okay, being downgraded by these rating agencies. Well, today, honestly, they didn't even really care. They just shook it off, okay? It created a bit of a pause, but they just shook it off, right? So one of the things I wanted to show you guys tonight, I'm going to show you, yeah, all right. I see a question here first in the chat. Can you speak to today's doji candle? Is that a true doji? So a doji is a specific candle formation, candle pattern where you have indecision, no clear winner for the day, right? If the bulls win the day, what happens? Candlestick goes up. Bears win the day, what happens? Candlestick goes down, right? They had the control. The sellers sell, it creates a red candle. The buyers buy, it creates a green candle. Well, today we had a green candle because we did technically move up from the open. But to Cannon's question, it's pretty tight, isn't it, right? It just looks like a little cross almost, a little star. Okay, now is that a true doji? Well, I'm not personally concerned with whether something is a true doji. That's not a commentary on the question. It's a great question. But when I'm looking at it, I'm not necessarily going, is it exactly a doji or is it really, really close? But to the point or to the question being asked, there is a little bit of movement up from the low of the day, right? It did push up closer to Friday's close, even though it didn't quite get there. So Would I call that a doji? Yeah, pretty darn close. Over here, you can see some candles where it literally is the open of the day, 43.84, and the close of the day, I'm sorry, 43.84 is the open. The close of the day, 43.83. Okay, so we're about a point different. Okay, so that's pretty darn close. That's a doji. Nobody got anywhere there. Okay, today, right, if you look at the candle, and this is something that traders learn to read, is different candlestick patterns. Okay, the open is 44.06 and the close is 44.11. So it's a few, but not much, right? Not much at all, and it was down from Friday. So is it a doji? Now, sometimes a doji can show us a reversal. If we're getting big candlesticks on a move up and then it stops and gives us a doji, that tells us that the momentum has shifted on that pattern. Okay, it hasn't dropped yet, but the momentum that was creating those big green candles just dropped out of the pattern. Something worth noticing, right? There really is a skill set here. And I've said this many times. You guys, probably some of you know what I'm going to say. It's not about learning the skill set so that we can know the future. It's about knowing the skill set so that we can read momentum, probability, and take advantage of that with good risk management. That's trading. That's what trading really is. So I want to show you guys this. I'm going to head over to this other page here. I can't share two at the same time. So let me know in the chat, has anybody out there ever looked at this before? Okay. This is part of the reason for the downgrade. Okay. One of the things that any credit bureau is going to look at for you and me when they're giving us a credit rating, they're going to look at debt to income ratio. And I've said this for years. If we ran our households the way that the US government runs its finances, okay, I always pause here and say, yes, I understand that the economic situation for an entire country, right, the biggest economic engine on the planet, is going to be a little bit more complicated than just household finances. And yet, perhaps we could learn a thing or two from some really simplified economics, that when you are constantly spending money that you don't have and you're just creating more, okay, which only devalues what you have. And what you do spend, you spend it on things that don't make any money. It's not a great long-term economic plan. Okay. And what you're seeing here on the screen is something to do with, right? This was part of the comment today when the downgrade came. We're stepping a little bit outside the stock market here, just getting a bigger overall picture. One of the things we want to do at Tradeway is break down the confusing world of finance for folks, right? And so this is a piece of that where if you look at this national debt, okay, you'll notice up in this top corner, okay, particularly, this is the U.S. national. You can see a lot of other statistics on here. By the way, you can just go to this. This is just public information. Go to usdebtclock.org, okay? Debt per citizen, 100,383, okay? Per taxpayer, 259,103. Somebody can have $20,000 in credit card debt and feel like, man, we got to chip away at that a lot. Okay, we have lots of people who are understanding that there's good debt and bad debt in our community. Bad debt is buying things that don't do any good for us outside of immediate gratification. They're not assets. They don't build long-term wealth and legacy. Okay, but then there's debt that starts businesses, acquires assets. They pay a better return, certainly the potential, than the cost of capital put into said asset. Okay, this is just straight up debt. Okay, and it's a heck of a lot more than 20 grand. And at the same time, okay, we're spending so much money so fast, creating so much money so fast, which I'm also going to show you right now. Okay, just quickly. Let's see. I'm actually going to have to do this here. That we are devaluing our own currency. That's what the inflation really is. Okay. It doesn't go as far. Here I go. One more screen. A little bit different tonight. We don't normally do this here on Market Monday. But look, let's just take a look here at the money supply, folks. Okay. Now they've discontinued this because they don't do this particular chart in the same time frame. They actually stopped doing it, probably because it looked so bad. But you can look here at the money supply. Okay. Here we are back in the 1970s. Okay. And from the 1970s up through these gray areas, which signify recessions, even up to the Great Recession here in 2008, 2009, you're seeing pretty, at least comparatively speaking, slow movement upwards. Okay. Then you'll notice over the next 10 years, even before COVID, okay, it doubles in that time. So already, guys, we're getting into territory where we're manipulating the economy in ways that we've never done before. We're in uncharted territory there. And then, of course, COVID, and it blasts off from there. Okay. So then that takes us back to, okay, just to take a quick look at that screen. And let's go back to where we started, okay, where we're looking specifically at the stock market. I was saying to a student earlier today, let's just imagine if I show you the 3-year view. So this is where we were at the highs, okay, pumping money like crazy into the economy. Where'd all that money go? Did you get a lot of that money? Who got all that money? Yeah, you got a check, right? And who knows, a lot of Americans did different things with that. Okay. I was going to say hilarious, and there's nothing funny about it really. In the fall of this year, I heard certain commentators from Wall Street commenting and saying, well, we could see a real contraction in consumer spending here into the Christmas season because, the consumer out there that received the check during COVID, right? The relief check has depleted their savings from the COVID rebate. And I'm thinking, how out of touch do you have to be to think that a $1,300 check that was given out in the summer of 2020 is now just being depleted for the typical American household in the fall of 2023. It literally boggles the mind. But they pumped that money into the economy, also, AKA, that's what I'm looking for, Wall Street, okay? The money went to the people who know how to get into the middle of it. And it went to Wall Street, and it went bonkers. And this is where we were at. Guys, we're not that far from there. So it's still just showing quite a bit of resilience here. Now we're kind of looking in the investor hat here. Okay. On the trading side, we're saying we got news coming, and we definitely want to follow the pattern here. But it's just continuing to grind higher. If they go ahead and they lower interest rates at some point next year, even second, third quarter, okay, I am not going to make predictions here. That's not really what I do. Okay. There's no point because you can get them right. You can get them wrong. Most of Wall Street, by the way, over the last year was wrong. Okay. And the CEO of JP Morgan Chase, okay, said Wall Street got it all wrong last year. So they make predictions, and that's not our job. Our job is not to make predictions. Our job is to manage risk and take opportunity based on probability, which we get from pattern, among other things in our system. That said, my point is we could see stocks just go way, way, way higher if we start to see interest rates come down. Look at the housing market, how people are doing right now, right? Where more people are priced out of the housing market than ever before. Those prices that went so much higher in COVID, they're not really coming down at all, except now the cost of capital is significantly higher. We don't anticipate housing prices to really come down much at all unless we see a severe economic reset of some kind. And if they begin to cut interest rates early, then you'll just see home buying skyrocket again. And we could see that go even further, that much further than it is right now. What's to say it wouldn't be the same thing in stocks? So it's a great time to understand, learn, dig in, get the skill set of trading because there's unprecedented times ahead. You know, there's been quite a bit of volatility in the markets, but we can flow with that once we have skill sets in the markets. So bigger economic picture there for everybody. Tina says very, very troubling, right? It's good to know what we didn't know, right? Once we know what we didn't know, even though we can't unknow what we didn't know, we can prepare for what we didn't realize was happening, right? You maybe didn't know that the CPI report is going to come out tomorrow morning at 8:30, right? So that'll be something that we'll watch. We're not going to try to guess or predict what it does. We don't need to, but it's something that we know is going to be important for my traders out there that are watching news tomorrow, okay? So that said, I also mentioned I want to dive into something, just something interesting to give you here on Market Monday, a little bit of information that's useful for folks. One of the things that's very popular and becoming all the more popular has been knocking off what used to be more popular, which was mutual funds. Okay. Mutual funds, a very, very common, very popular product. There's many, many mutual funds. It's not my intention to give commentary on all mutual funds, but one thing that is replacing them en masse and is very popular are ETFs, not mutual funds, but exchange traded funds. The basic thing I'm going to highlight today is that the ETF is a financial product. You buy it in shares, just like a stock, except that you're not going to pay the same kind of management fees on the ETFs that you've been paying most likely on those actively managed mutual funds. These are passively managed. Okay. So, for example, I get this question all the time, Blair, can I just go out and buy the stock market? Right? Can I buy the S&P? Can I buy the NASDAQ? And I would say yes, in one sense. And one of the most common ways to do that would be, look over here on my screen, the S&P 500 ETF. Okay. It's an exchange traded fund. It's a product, okay, that tracks along with the index itself. I'll go ahead and, oh no, let's save that. I'm going to take that guy. I'm actually going to just drop that right there. It's an exchange traded fund. It's an ETF. It's a product that gives me the ability to go out and buy the market, okay? But it's not the market. Because remember, the S&P is an index, okay? So this is actually a stock, but for every 10 points the S&P 500 moves, the SPY, which is what I'm looking at right now, or the SPY, okay, it moves about $1. Okay, about $1 move here for a 10-point move in the underlying index. On indexes, we don't say dollars, we say points. Wall Street likes to make it as confusing as possible for everybody. So if you and I were looking at Apple, we would say dollars. Apple went up $1, it went down $1. For the S&P 500 index, it's just one of the indexes, but it's a major one that we use, you'd say points. So for 10 points in the S&P, $1 in the SPY, right? You can go over, and we'll do this occasionally here on Market Monday. Well, let's look at the NASDAQ, okay? The NASDAQ, okay, also decidedly breaking through what? Oops. Breaking through. Oh, that's not what I meant to do. Let's go like this. There we go. Breaking through, pulling back to the 5-day. Nice follow through. This was really clean. This was nice. So can I buy the NASDAQ? Well, we could come out to one of the most popular ETFs there is, QQQ, or what is known as the Qs. So you go out and you actually can buy the index itself. Okay. Now, I'm not recommending tonight go out and do this or do that. What I am saying at this juncture is you've got these ETFs that, again, have become very popular. Some of these are the most popular, highly traded securities out there, right? Certainly, they have generally very high liquidity, very popular, to be looking at these. And these are just two. Okay. There's some interesting stuff. I noticed today with what's going on with interest rates and things of that nature with the Federal Reserve and the downgrade and all this kind of stuff. Well, as interest rates move, it really moves certain parts of the stock market, as we've talked about for sure, but it also moves the debt securities. Okay. We've got treasury bills, bonds, all kinds of things over there. That is something that actually has it's a very large market as well, and certainly has a lot to do with the Federal Reserve and interest rates and things like that. Well, instead of going out into the bond market, there are ETFs that trade certain parts of the bond market, depending on what happens. Okay. This is the 20-year Treasury bond. It's an ETF. It's a product in the stock market that is, in essence, trading a different market. Okay. It's not a perfect correlation between the two in all cases. Okay. Another one we could look. Oh, it didn't take us there. There we go. ETF for gold, and it moves based on activity in gold. Okay. So that is an interesting connection. And what I'm highlighting here is you can find an ETF for just about anything, right? Kathy Wood has her famous ARC Innovation ETF, where she takes a lot of emerging technology, packs it into an ETF, and sells that. When the money was fast and cheap, right, over 2019, 2020, 2021, right? We go back here, not even 2019, just very early, or excuse me, very late 20. I don't think this is, there we go. That makes more sense. I knew we were back further than that. So there's into 2019. You'll notice, look at this, March 2020. It just goes stratospheric. Okay. And now it's just been destroyed, right? So this particular one, very high risk, high return for a long time. This one, well, guess what? You could get an ETF of this particular fund, which is just an example I'm showing you tonight, guys, right? This was a very popular sort of Wall Street darling for a little while. You could see it on all the news, and everybody wanted to know, what's Kathy Wood saying? I'm not going to say that we were looking for that at Tradeway here, but it certainly was this sort of popular thing in financial news, right? But you can buy an ETF that moves the opposite direction. So when this one goes up, that goes down. Okay. Right. Let's go over and I'll just show you a couple more. I'm just giving you exposure to what this is. SPXS. Okay. This is an ETF that tracks with the market. Okay. I got to expand here. Okay. But this one, now they're not all made by the same company, right? These aren't all equal. And I'm not suggesting we go out and buy these. Okay. That's not my point today. I'm exposing you to the world of ETFs. You could get a healthcare ETF, a utilities ETF. We could go to the financial sector, XLF. This is the S&P financial sector. So if you're wanting to look at banks and financials, you could go over here and just look at the entire sector. Okay. Back to this other one that I mentioned. Okay. Or even we looked at the Qs. So here's the Qs, the NASDAQ, but it's short. Oh, I didn't mean to do that. Okay. Meaning this one actually goes the opposite direction. When the Qs go down, this one goes up. So it shorts it. It's opposite. If the Qs go up, this one goes down. So if you wanted to trade the Qs, the NASDAQ, right? You wanted to be bearish on the NASDAQ, these shares would make money when the NASDAQ goes down. And it does it with leverage, right? Some of these are going to actually move triple what the index moves. Okay. So very interesting. Very interesting. The world of ETFs. Just a window into it today, right? Not the full picture, but knowing, hey, if you ever think, I wonder, is there an ETF for, say, microchips, right? Is there an ETF for S&P Energy? Is there an ETF for the Dow Jones Industrial Fund? Okay. In most cases, the answer is yes. In most cases, the answer is yes. And for most people, I'm sorry, Tina, I left that up on there. For most people, one of the things is going to be more like some of these passive index funds. Now, this isn't the only one, obviously, right? But I say to people, and this is where I'm going to end tonight, if you own mutual funds, theoretically, let's say somebody owns mutual funds, and the purpose of that fund is to beat the indexes, right? The benchmark, they call it on Wall Street. The benchmark, meaning what? The goal. It's what everything else is measured against. That's the benchmark. So we want to know, are we doing well if we're above or even at the benchmark, or we're not doing well if we're below it? Well, most funds, not all, most funds don't beat the indexes. And when you add in the kinds of fees that people pay on actively managed mutual funds, okay, then that is going to give you even less of a chance of beating the indexes. So one of the things that's popular on Wall Street is, well, what if I can go out and I can get an ETF that basically is the index and it's a low fee? Something worth thinking about, right? The more you know. You didn't know what you didn't know. But when you know what you didn't know, you could go where you didn't know you could go. That's the idea. So appreciate everybody being on here tonight, right? We just did the fire hose here, 36 minutes on Market Monday. We're here every Monday. Like I said, kicking off the week because we've got a week of content coming up, right? We've got Tip Tuesday, Word Wednesday. We've got some live trading coming at you on Thursday as well, right here on Tradeway TV. So stick with us through the week. If you haven't, like and subscribe, Facebook, YouTube. We'll send you notifications every time we got great content coming up so you don't miss anything. You can always come back here and watch anything that you missed as well. I appreciate each and every one of you being on here. Tina, Cannon, Shell. I've got AE on here as well, Rob. Thank you guys for being here because it's really all about you. It really is all about you. And we're so thankful that you guys are joining us here and are a part of our community. One last thing, AE is saying, I am a Tradeway member. How does one become your student? I often hear you say, I tell my students. You've got an account. You can log in. If you have any questions regarding your account or memberships or anything like that, you can always reach out to us at support@tradeway.com, support@tradeway.com, and we will help you out right there. If you've never become a student, you've never taken one of our classes, you've joined us here on YouTube, but you haven't taken one of our classes, you can head on over to tradeway.com/events right there on the tradeway.com main page and take our Step 1 Start Your Journey class. Okay, you can take it right there off the main page. Step 1, start your journey, and we'll take you through the foundation of our system and how we train people to be traders in the stock market. Okay, Cannon says, so someone would trade an ETF for something that doesn't have a ticker symbol? No, it would have a ticker symbol unless you wanted to trade something like Cannon, I mentioned like utilities. Let's just take that as an example. If you wanted to trade utilities, well, you could go out and you could find individual utility companies, or we looked at financials tonight, right? XLF. That's the ETF for the S&P financial sector. Okay, so you're going to trade the financial sector if you own XLF. Okay. But you could go out and you could trade different stocks within the financial sector as well. You could go buy a bank. You could go buy a specific lending institution. You could buy different kinds of companies within that sector that you're going to be able to do individually, or you could do more broadly by buying that sector as a whole. Okay, so I wouldn't say that they don't necessarily have a ticker, but it may be representative of a whole, right? As you look at an industry or a sector, okay? And you can get very specific. There are a lot of ETFs. We've got to still follow the same rules, follow a plan. There's no silver bullet in ETFs here. And it's not to say that they're all created equal. However, I want you to know what they are, some of the pros and cons around what they are in contrast to historically the mutual funds, so that you're a better educated investor as you look and as you trade as well. Okay. Thank you guys for being on. Appreciate each and every one of you. If you have any questions, support@tradeway.com. Let me know. See you next time, guys. Good night.